Happy day. This is Dr. Sree Akshara Mithran from the Department of Commerce from the program BCom Accounting and Finance Shift 2. Today, I am going to take a topic on capital gains under section 45 under the chapter Income Tax Law and Practice 2. So, let's see what is capital gain. Capital gain is the fourth head among the 5 heads of income. And what is capital gain? Capital gain is any profits or gains arising from the transfer of the capital asset effected in the previous year shall be assumed as an income in the previous year in which the transfer took place. That is, any profits or gains arising from the sale of transfer effected in the previous year shall be considered to be as an income in the previous year in which the transfer took place. On what basis does a capital gains be charged? That is, it must satisfy certain conditions to charge capital gains. That is, first, it must be a capital asset. Second, it should be transferred by the assessee. Third, the transfer should have happened during the previous year. Fourth, the profits or gains must arise from that particular transfer, and such profits and gains should not be exempt from 54, 54P, 54D, 54EC, 54G, 54GA and 54GP. So, the first condition was capital asset. So, let us see what is a capital asset. A capital asset is defined under section 2 subsection 14, which includes property of any kind, whether fixed or circular, movable or immovable, tangible or intangible. Yes. So, however, certain capital assets are excluded from being a capital asset, that is stock in trade, which is raw materials, work in progress, unfinished goods, etc. Second, personal assets, which are furnitures, electrical appliances and your motor vehicles are considered to be as a non-capital asset. However, there are certain exceptions, that is jewellery. Jewellery, even though it is considered to be as a personal asset, it is considered to be as a capital asset, such as personal metal, precious metals such as gold, silver, platinum, even stones, which is precious stones. Whether or sewn or non-sewn, it is considered to be as a capital asset. However, archaeological collections, drawing, arts and sculptures are considered to be as a capital asset. Then we have agricultural land in rural area. Here you have certain conditions, that is, the land should not be situated in any municipal or containment board having a population of 10,000, and then if it is in case with the distance measured aerially from the municipal or containment board is as follows, which is 2 kilometers, the population must be from 10,000 to 1 lakh. Then within 6 kilometers, the population must be from 1 lakh to 10,000, and within 8 kilometers more than 10 lakhs. Then we have certain more non-capital assets, that are gold bonds or national defense gold bonds issued by the central government. Then we have special bearer bonds. Then we have gold deposits bond issued by the gold deposit schemes and deposit certificate issued by the gold monetization scheme in 2015. Then let us learn about the types of capital assets, which is first short term and long term capital asset. So, here are few capital assets, that is how do we differentiate these types of capital assets, short term as well as long term. So, it is the period of holding of a particular capital asset, that is, if these capital assets such as equity preference shares of the company and debenture, bonds, gold security derivatives, etc. Then we have unit oriented mutual funds, UTI, zero coupon bond. All these capital assets, in case if the period of holding is less than 12 months, then it is considered to be as a short-term capital gain. But if the period of holding of these capital assets is more than 12 months, it is considered to be as a long-term capital asset. Similarly, we have equity preference shares which are not listed in a recognized stock exchange, and immobile property such as land and building. If the period of holding of these capital assets, if it is less than 24 months, then it is considered to be as a short term capital asset. If the period of holding of these capital assets is more than 24 months, it is considered to be as a long term capital gain. So, there are two types of capital asset, long term and short term capital asset. In case these capital assets such as equity preference, debentures, unit oriented mutual fund, UTIs, zero coupon bonds, these assets, if this asset is holded for a period of less than 12 months, considered to be as a short term capital gain, more means long term. And in other case, equity preference shares, immobile property, if it is holded, it is 24 months. So, there are two period of holdings, one is 12 and other is 24 months. Then we go to the capital gain calculation. That is, we have a format for calculating the taxable short term capital gain as well as taxable long term capital gain. First, we will see the short term capital gain, that is full value consideration. Full value consideration is nothing but the sale price of that capital asset, and less transfer expenses. Transfer expenses, in case any expenses incurred during the transfer, that amount you can deduct it over here, in which you will get your net consideration. Then deduct cost of acquisition. Cost of acquisition is nothing but your purchase price of that particular asset, and cost of improvement is any kind of improvement done during your, let us say for example, if you have purchased a house and that particular asset, for example, you have purchased, your capital asset is a house, any renovation done during that period of time, that particular improvement, that amount of improvement can be deducted over here. Okay. Then you will get your gains before exemption, then less exemption claimed, exemptions claimed are 54, etc. And then finally, you will get your taxable short term capital gain. Similarly, how to calculate taxable long term capital gain is again same way, full value consideration, which is your sale price, less transfer expenses, which is your expenses incurred during your transfer, and in which you will get your net consideration. And then over here there is a difference compared to your short term. You will have indexed cost of acquisition. Why indexation is done is, your asset might be purchased earlier, that is let us say 1990 or so. To understand the current market price, for that we have indexation. So, we will find the indexed cost of acquisition using certain formulas which we will see later. Yes. So, indexed cost of acquisition and indexed cost of improvement, and after that you will get your gains before exemption, less exemptions claimed, that is 54, and after finally you will get your taxable long term capital gain. So, let us see, over here we saw indexed cost of acquisition and indexed cost of improvement. Let us see how to calculate the indexation. This is your cost inflation index. So, we have been given a financial year from 2001, you have your CII, which is your cost inflation index is given. So, for each year we have an indexed CII given. How to calculate indexation? So, we will calculate indexation, that is, if your asset is purchased before 2001, then we have a special formula which is your actual cost of that particular capital asset or your fair market value, whichever is higher, we will take into CII year of transfer. CII year of transfer in which the year of transfer took place, which should be your previous year. Yes, divided by CII of 2001 and 2. That is the base year. So, we will consider to be as base year, which is 2001 and 2 is 100. So, if the long term capital gain is acquired after 2001, then we have a special formula, which is cost of acquisition, which is your purchase price into inflation index of the transfer year. So, inflation index of the transfer year is in case your long term capital asset is acquired after 2001, then you have certain formulas which has to be used. That is cost of acquisition, which is your purchase price into your CII year of transfer, which is your previous year, divided by inflation index of your purchase year, that is in which year the asset was purchased. And similarly, we have the same formula for calculating the indexation of cost of improvement, that is COI, cost of improvement, that is whatever the cost incurred for the improvement, into inflation index of transfer, that is your transfer year, which year the transfer took place, that CII, divided by the in which year the improvement had been done, that CII will be taken into consideration. So, finally, let us see a problem under which you will be calculating. So, let us see this problem. Compute the taxable capital gains for Miss Vidya from particulars given below. Sale of residential house for rupees 10 lakhs, which was sold during 2/6/2024, which is the previous year. The cost inflation index is given as 363, and cost of acquisition, which is your purchase price of this house, is 2,10,000, which let us consider this house was purchased on 1st May 2007. Over here the cost inflation index is 129. How do you consider this? So, the CII which was purchased on 2/6/24, the CII is 363. So, let us go back to your cost inflation index. The year in which the transfer took place is 2024 to 2025. So, your cost inflation index is 363, and in the year which the purchase was happened was during the year 2007 and 2008. So, your cost inflation index is your 129. Okay. So, using the formula, so what are the four things which we should see first is, first, whether it is a capital asset or not. So, a residential house is a capital asset. Second, whether what is the period of holding, that is whether it is a short term or a long term capital asset. Over here the purchase was a residential house, so it is a capital asset, and it was purchased during the year 2007, which makes it a long term capital gain, which fulfills the conditions of, that is 24 months. The particular capital asset, if it is held more than 24 months, this is considered to be as a long term capital asset, and all the cost inflation index is given. So, how do we calculate the long term capital asset? Full value consideration, that is the sale price, is 10 lakhs, and cost of acquisition is 2,10,000. Over here, since the asset was purchased earlier, we need to find the current market price, so that we need to do indexation. Formula is cost of acquisition into CII year of transfer divided by CII year of purchase year. So, 2,10,000 is your cost of acquisition. The CII year of transfer is 363 divided by CII year of purchase is 129. So, 2,10,000 into 363 divided by 129 will give you your indexed cost of acquisition. So, we have done it over here. So, full value consideration is 10 lakhs. Your transfer expenses is not given. So, we considered it, assume it as nil, and net consideration will be 10 lakhs. Automatically your index cost. So, we use the formula 2,10,000 into 363 divided by 129 will give you 5,90,930. With that, we have indexed cost of improvement. No improvement information was given, so we considered it as nil, and you will get gains before exemption will be 4,09,070, and with that less exemption claimed, no exemptions is claimed. So, your taxable long term capital gain is 4,09,070 rupees will be your taxable long term capital gain. So, hope you have understood the basics of capital gain. Thanks for watching. Like, share and subscribe M.O.P. Classrooms for more such videos.